Bueno, muy buenas tardes. Voy a comenzar entonces con la lectura del artículo. Listo. Entonces, a novel future engineering approach for high frequency financial data highlights. Future engineering for high frequency financial data based on time series segmentation. This methodology allows us to extract and analyze variables by intraday trends. It also allowed us to feed artificial intelligence models to forecast response variables in future trends. It is applied to forecast high frequency volatility, duration, and direction linked to future intraday trends. Experimentation was conducted using high frequency financial data from the Brazil Stock Exchange. Abstract: Feature engineering for high-frequency financial databases on constructing dynamic data subsets defined by timed intervals in which high-frequency trends occur is proposed. These intervals are obtained through time series segmentation. This methodology allows us to extract and analyze variables by intraday trends as well as to feed artificial intelligence models to forecast response variables in future trends. Furthermore, to show how to use this future engineering, this methodology is applied to estimate high-frequency volatility, duration, and direction linked to future intraday trends, developing multi-class classifications models based on the machine learning method extreme gradient boosting. Experimentation was conducted using high-frequency financial data from the Brazil Stock Exchange, corresponding to 206 trading days related to 20 listed assets from this financial market. Introduction: In the new technology era, artificial intelligence has become a central issue for data science, with applications in numerous fields of study. One of these fields is finance, where machine learning techniques have emerged as powerful tools to extract knowledge from high-frequency data and have become an increasingly important research area to tackle high-frequency financial data analysis and forecasting. On the other hand, the widespread use to electronic systems on stock markets has made it possible to store this data with the high precision with which they are generated. This situation has caused a boom in the application of learning algorithms to this type of data, as shown in the comprehensive review presented in McCarthy et al. 2018. These data are characterized by being generated at irregular intervals with precision of milliseconds or even higher frequencies, which causes there to be high volumes of data containing multiple variables. In other ways, we are not dealing with usual time series, since these data come from buy and sell orders that arrive to the market system, where some of these orders intersect, giving rise to what are called trades, and others remain quiet. Whose processing consists of the reconstruction of the so-called limit order book. The final data contains multiple variables that evolve over time, which has contributed to the fact that these data have been the subject of a multitude of research work from a statistical point of view. However, the very nature of this data causes their distribution to not be maintained over time. So this circumstance has created a suitable framework to address the resolution of forecasting problems of this data with other kinds of methods based on artificial intelligence, in which it's not necessary to make assumptions of the distribution of this data. The progressive scientific interest in the combination of knowledge fields related to high frequency data analysis and artificial intelligence methods for forecasting purposes is evident in the multiple references cited in this scientific article, most of which have been published in recent years. This growing body of literature recognizes the importance of using machine learning methods to analyze, model, and forecast financial markets. Moreover, there is strong private sector interest in this research topic because investment banks, hedge funds, and other wealth management firms are competing to obtain successful forecasts in addition to higher returns and lower risk. To apply machine learning techniques to route data from financial markets and solve multiple high-frequency forecasting problems, it is necessary to extract relevant features from this data. So these must be previously analyzed and treated using and allow us to achieve this objective. The literature reviewed contemplates feature extraction on set of observation with a constant number of elements, making forecasts on a fixed forecast horizon. This is the situation of the usual forecasting problems in this research field, such as volatility estimation and directional forecasting linked to price movements. In such cases, the cited forecasts are made based on a previously defined sampling scheme and forecast. However, volatility is a variable that presents clustering in its values and does not have symmetry with bullish and bearish movements. Ingle and Patton, 2001. So it seems reasonable to group volatility, values, and intraday trends movement. In addition, high-frequency quotes tend to experience intraday trends with irregular duration. These particularities arouse interest in knowing that the evolution of the relative volatility could be was linked to intraday trends duration or what direction or duration a future intraday trend would have. However, the posed problem is not limited to these variables. There are many others whose evolution could be linked to intraday trends. To the best of our knowledge, there are not published works that have focused on the extraction of features exclusively from clearly defined high-frequency trends, whose objective is the design to feature engineering that allows forecasting variables related to the future trends using methods based on artificial intelligence. This gap in the literature has motivated us to propose a new problem not previously addressed and to face the great challenge of accurately segmenting high frequency time series with tens of tens of thousands of daily observations to obtain high frequency trends and extract features from them, as well as from the associated limit orders. Thus, the research objective is to extract features from intraday trends in the trade series and from the limit order book states at every time in the trend movement. Therefore, a methodology that meets this objective was developed, which provides answers to the question previously formulated, since it allows us to analyze variables other in time intervals in which intraday trends occur and to estimate how a variable will behave in future intervals, using values from variables in previous intervals and treating them as regressors that explain the variation in the response variable using artificial intelligence models. The sampling and forecasting chain in this methodology constitutes a different approach from the traditional one, whose usefulness in aimed at solving a specific problem with high-frequency financial data, where the purpose is to analyze variables over time intervals in which intraday trends occur and estimate dependent variables in future intervals. Therefore, the main contribution is a methodology to extract features from subsets with variable composition. The general structure of this document is organized into 7 sections, including these introductory parts, the states and the related to this experimental research with reviewer in section 2. In section 3, research the problem is stated and the proposal is proposed. Section 4 includes to the application of the developed methodology to forecasting problems, in which the artificial intelligence algorithm extreme gradient boosting is applied. Section 5 contemplates the extensive and laborious experimentation conducted in this research, in which the designed methodology is executed and evaluated, and in which developed feature engineering is applied to three specific forecasting problems. The results are discussed in section 6. Finally, concluding remarks are started in section 7. Section snippets. Related work. In general terms, the state-of-the-art research related to this study is framed in the scientific field related to the application of artificial intelligence methods to high-frequency financial data. Specifically, it is feature engineering for high-frequency data, where the existing methods start from data subset with fixed composition, from which the corresponding features are extracted. In contrast, the developer feature engineering contemplates an additional previous step. Methodology. Time series trends have a variable number of observations. It is intended to extract features from intraday trends and from the limit order book states at the times of these trends. This is the problem proposed to solve, whose solution allows the analysis of multiple variables in subsets defined by time intervals in which intraday trends occur and allows the estimation of response variables in future trends by feeding artificial intelligence models with the extracted features. Application. As highlighted In Kercheval and Shang 2015, statistical methods often impose mathematical assumption of models on models, which would require intensive computation that would complicate their application to forecasting problems such as those posed in the application of our methodology, where large volumes of high-frequency financial data are used. Other authors also agree on this issue, such as Nosy et al. 2019, who remark that the design of models based on machine learning methods does not need to experimentation. In this research, real data and supercomputing resources have been used, which are described in the following subsections, at are different stages followed to obtain the results shown in the section 6. Results and discussion. The values of the performance metric obtained from the forecasts made with each machine learning model built to forecasting the variables volatility, duration, and direction and are presented in Table 8, Table 9, and Table 10, respectively. The results are sorted by ticket and performance metric, that is, kappa and F1 score for each of the three classes. Additionally, the values that delimited each class region are shown in the columns named Q13 and Q23. Concluding remarks. Using a time series segmentation method, future engineering that allows extracting futures in high frequency intervals where intraday trends occur was developed. The intervals resulting from this segmentation were extended to order book data to extract futures from their states in these intervals. This methodology facilitates the analysis of variables in intraday trends and their estimation in future intervals through artificial intelligence models. Bueno, ya en castellano, ¿cierto? Un pequeño análisis de lo que nos dejó el artículo. El artículo deja dos aprendizajes clave. Nos muestra la importancia de ir más allá de los métodos tradicionales, combinando estadística, programación y aprendizaje automático para resolver problemas complejos como el análisis de datos financieros de alta frecuencia. Introduce un enfoque innovador de segmentación dinámica que mejora precisión de los modelos predictivos en los mercados financieros, precisamente con el uso de inteligencia artificial. Y especialmente en sectores como finanzas, en el data science o en tecnología, el estudio resalta el valor de desarrollar soluciones a medida según la naturaleza de los datos, aprovechando herramientas avanzadas como inteligencia artificial precisamente. También subraya la necesidad de adaptarse al cambio constante del mercado, utilizando metodologías flexibles, que sean escalables y que sean basadas, por supuesto, en datos reales. Muchas gracias.